Hey guys, we are right here with my good buddy Hugh Hendry on Hugh Hendry's official YouTube channel and maybe Twitter.
Without a doubt, we are on
Going out to the
X.
whole world. That's right. So you wrote a thread today and you put a lot of thought into it. And it concluded with something called the Kobayashi
Maru.
Is that what it was?
The
Yeah, you want to explain that?
The Kumbaya. But it's the mythical name of a Starfleet vessel, which is fundamentally compromised, and Captain Kirk is faced with a dilemma. It's a no-win scenario. There are no solutions.
And the punchline is the Fed is now in the exact same position.
That's what I believe. So people might think I'm all over the place. That may be true. Interest rates, are they too high or too low for the US? What I think we can say is that they're too high for the rest of the world.
Yeah, right.
And that's a fundamental shift. And we all know, we call it sometimes the dollar standard. But really it's using the collateral of US treasuries to create dollars in the offshore market. And presently, indeed for forever, you've been able to borrow in yen and put it into US assets.
So low interest rate, high interest rate.
So you borrow at nothing and you invested 5.5% in US cash, and the recent investor expectation is you're getting 20% per annum gains from the stock market. Now the complication previously was that the Japanese currency was rising, and so you had a free carry, but you had to repay in yen.
The FX risk.
The FX risk, which has been stood on its head. The Japanese yen is devalued by an astonishing 40% in the last 18 months, coinciding with the demise of the Chinese property sector.
Yeah.
Okay? And so now you can borrow at zero, invest at 5.5 with no risk, and repay your yen liability for less and less.
Yeah.
And what that's creating is a cascade of risk capital coming in and inflating and taking US risk asset prices higher and higher.
So why wouldn't you?
Why wouldn't you? So, but higher and higher asset prices bring a fragility because trees don't grow to the sky. And if you start from overvaluation, when you get the inevitable mean reversion, it could compromise the entire global financial monetary system.
Yeah.
Okay, so the no-win scenarios, what does the Fed do? Okay, and what I was trying to write today is, well, the Fed could have a synchronized rate cut with other global central banks and say we're in it together. And you would be subjugating the demands of the US economy. And I'm the first to admit, hands up, that George, I got it wrong. The fiscal policy is of such a magnitude, and it's baked in. You haven't even spent, I don't think, half of what's committed.
And the TGA right now is at 700 billion.
Yeah, but growth is baked in until 2027. Okay, and for the Fed to cut rates, they would have to subjugate. They'd have to say, yeah, we know our economy is strong and it's not warranted, but we need it for Japan, we need it for China, and my God, do we need it for Europe?
Yeah.
So that's a no-win scenario, because that's what Benjamin Strong did, the New York Fed chairman did in 1927. He cooked the whiskey, he cut rates to help the British sterling, and what happened? The stock market, grew like ivy on a wall.
Yeah, so then he becomes Arthur Burns. So you got to look
Burns.
at, so Powell, if he does that, could be considered Arthur Burns because he drops rates to save the world, but people think that he should be focusing on the domestic inflation rate. So if he does that and inflation does take off again as a result of that, then he goes down in history as Arthur Burns, which is the opposite, obviously, of what he wants from a standpoint of his legacy.
But don't forget Greenspan. So the Fed has formed. It did this in 1998. 1998, we had the Asian tiger crisis, the crisis of sovereign nations like Thailand in Asia. And something breaks when sovereign currencies start to have huge volatility. Something breaks. Back then it was LTCM.
And did the Fed drop?
Fed dropped.
Oh, okay.
US economy in the third quarter of 1998 was booming. The Fed cut interest rates, and we all know what happened. NASDAQ.
I wonder what was the CPI back then, do you remember?
CPI was I don't know. It could have been around these levels,
Yeah,
1989.
That's what I was thinking.
But it was asset price. It was the asset price inflation. So that feels like a no-win. If the Fed cuts in unison with other central banks, you get a Nasdaq 1989. Prices will be 40-50% higher in a year. Okay?
Yeah.
So that doesn't feel good. The alternative is do nothing.
But then the world crumbles and takes the U.S. down with it.
There you go. It's a no-win scenario.
Yeah, that's the Kobayashi. That's Captain Kirk painting himself into the corner.
We're going to lose the Starfleet Enterprise vessel. But George, you looked today at the GDP statistics. You got something to say there?
Well, it's a head scratcher. It really is, because you see real GDP going down. I forgot what the expectations were, but it came in at 1.6 or something like that. But the real part of the report that has the market shocked is the fact that the core PCE that I believe they outlined, the quarterly PCE that they outlined in the report, in that GDP report, went up just some crazy amount. And it really caught the market offside. So now it's all stagflation. And the real head scratcher for me is having stagflation when the metrics, the money metrics, called M1, M2. But it's specifically what I look at in M1 are checking deposits, time deposits, demand deposits. So I think that's the currency units that are out there chasing goods and services. I don't see how that can be crashing. Well, at the same time, we have, let's just say, another wave of inflation. I'm not saying we don't. I'm just trying to connect the dots right now, because people always refer back to the 1970s, and that's fine. I get it from the standpoint of the inflation going in waves and whatnot. But the money supply was going up in a straight line due to the banks extending credit back in the 1970s. And now bank credit's flat, if not declining, while M1 is really, really going down, and M2 has gone down the first time since the Great Depression. So I don't know how you get, I just don't know how to reconcile that.
Okay, so my attempt at the reconciliation would be that you're measuring the sovereign dollar creation. So we create dollars, the money supply in America, with the extension of new loans by the private banking sector. That's what M1, M2.
Most of it.
Yeah. And they're measuring bank deposits, but bank deposits are a liability, and banks therefore, when they have liabilities, they seek to create assets, and that's loans, and that's the money creation. But of course, what that narrative forgets is that there's even more money being created offshore by financial entities going to their counterparties and pledging their US treasuries, and then dollars are created. So
but those are outside the domestic economy. So I'm trying to figure out, within the United States domestic economy, you've got X amount of dollars and Y amount of goods, right? And then you've got outside of the United States, you've got a whole nother world of dollars.
So we have this huge mushrooming of speculative capital offshore, and then with the yield differential, it gets drawn to US asset prices, and so the euro-dollar creation flames asset price inflation. And then back to your conundrum, the lack of loan expansion domestically.
Or just the money supply. If those dollars were coming into the United States to buy US assets, I would assume that they would show up in a US bank, but they're not.
Well, because there's a buyer and there's a seller, and so it nets out as neutral, but its footprint is felt in higher asset prices. So I don't think you'll see 1970s price inflation for the factors that you're seeing, you're feeling. But the principal danger is asset inflation, because as the market climbs higher and higher, the profound drawdown in Nasdaq beginning in March 2000, it created what was one of the deepest recessions in the US. So when you get an inevitable mean reversion in asset prices, you're going to have a big recession. I would not choose to be Jay Powell today.
Yeah, and another thing I didn't talk about there that could kind of better connect the dots would be velocity, because theoretically, if you do have the money supply going down, you have CPI going up. If velocity is going up to a greater degree, and you see a decline in the money supply, then that could explain some of the I don't know what you want to call it, the ramp up in inflation. I just don't know how it's going to be sustained. I guess that's the takeaway.
So the no-win scenario is for the Feds. What are the scenarios for us? presently, and indeed with those scenarios, the central tendency is this non-sovereign dollar creation to continue to whip higher and higher US risk asset prices. So the central tendency is you have to be invested. It's a question of how much you invest. But my allocation would be small, and I've spoken before. So here I am, I'm in St. Bart's. My principal asset is a beautiful house here. It's a commercial property which I rent out. Let's say it has a hypothetical value of $10 million. And let's say I have $5 million of debt, hypothetically. So my net worth is $5 million. What I would always advocate is, as a risk portfolio, buying stocks and shares, what's my maximum allocation? And it would be 10% of the 5. So my allocation would be 500,000.
Right.
Yeah.
Yeah.
And then within that, I've been advocating like 100,000 in tech stocks, between 100 and 200,000 in Bitcoin, and recently with the breakout, and I think a breakout inspired by the yen devaluation, in gold, but gold, the yellow metal, and not these preposterous
And why don't you
mining
connect
stocks.
those dots? Because the Japanese are like, holy cow, the yen's tanking, I want to buy something, so I'm going to buy gold. Is that the argument there? Or the Chinese buying because they're worried about the real estate market? Or why is everyone going into gold? Why would you choose that?
The only important factor for me in terms of who's buying is if I'm buying. I don't care who's buying.
But why do you think the price will go up?
Because the yen, can I say it again? We've had a 40% devaluation in the yen. We've got 50 years of data. This is not supposed to happen. This is saying that the plumbing of the international monetary system is under profound attack and duress, and something's going to break.
So risk off.
Well,
Risk off gold.
gold is a risk. I'm speculating. I'm taking risk that the gold price is going to go higher. This notion that it's risk off. Gold is not an agent of chaos. Gold is the alchemy of chaos. Okay, and when you get to a point where everything is overvalued, smart, intelligent, aggressive investors say, you know what, this system sucks. Okay, and the biggest finger to the market is to buy the dumbest asset. Gold it gives you no participation in a risk enterprise. It has no carry. But when the world becomes chaotic and the system is out of control, it's like you give it to the man. And that's what I'm doing. I'm now saying, you know what, I'm giving it to the man.
Okay, well, now I get your investment thesis.
And then finally, you can buy. There are some ETFs like JP Morgan and others, and you can buy an ETF and participate in the yen weakness. This thing it's detaching itself. It's 156. I know I'm crazy, but I'm getting 200 at the voices in my head. You can capture that in low cost 39 basis points expense ratio funds out there. So I would have that. So there's things to be done. Yes, it sounds apocalyptic, but we're close to the 100-year anniversary of when we brought down the gold standard. And I'm thinking to myself, is it every 100 years you get a currency reset? And a currency reset, the portents of that is uncontrolled asset price inflation, which ultimately breeds this fragility and things break, and then everyone has to sit down and say, we need a new system.
Yeah, which is exactly, goes back to your original hypothesis that you included in that thread of the Fed painting themselves into a corner. Yeah. Or that just damned if you do, damned if you don't.
The no-win scenario.
Yeah. And on that bombshell,
the sun is shining.
It's fantastic here in St. Bart's.
We tried to get to the pontoon, but the sound quality was really poor.
Yeah. But we'll do it again soon.